Good morning. Hello and welcome to today's webinar on the latest announcements in the Labor government federal budget. I'm Amanda Castricum, I'm a partner at Mazars, and I'll be your host today. The budget contains no real surprises for a government that was taking stock of the nation's finances handed to it following its election win earlier this year. Many budget measures had already been announced since winning government. Described as a sensible budget for current conditions, it contained various cost of living relief measures, including cheaper childcare, expanding paid parental leave, and encouraging downsizing to free up housing stock. Key tax measures are targeted at multinationals, particularly changes to the thin capitalisation rules and changes to deduction rules for intangibles. Today, I'm joined by three of my fellow partners, Gabrielle Cleary, Jamie Towers and Michael Jones. They're our superannuation and tax experts that will take us through these tax announcements that we expect to impact individuals and businesses. In addition, we're going to be providing some planning suggestions for superannuation in anticipation of the future tax increases. Before we get started, I'd like to point out that there's an interactive feature in our webinar. By clicking on the three little dots in the bottom right hand of the screen, you can ask a question. We invite you to ask questions throughout the presentation. We've allocated some time and at the end of our session, we'll go through and answer those questions for you. We encourage that you provide your name and your email address along with your question or comment. That way, if we don't get to your question throughout the webinar, we can follow up afterwards. With that being said, I'm delighted to announce our first presenter, Gabrielle Cleary. Gabrielle is a partner with Mazars and leads our tax consulting division in Sydney. She's a tax specialist with over 25 years of experience in providing specialist taxation advice in all areas of taxation, with expertise in corporate taxation, international taxation and capital gains tax. She has extensive experience in areas of corporate restructures, mergers and acquisitions, employee share schemes and global mobility. She's also recognised author of a number of leading tax publications, including most notably the Small Business Capital Gains Tax Guide and the Master Tax Guide. Gabrielle's going to present for us today on announcements that impact individuals. Over to you, Gabrielle.
Thank you, Amanda. The federal government's budget had surprisingly few announcements from a taxation perspective for individuals. This is personified by the fact that the main announcement for individuals was an increase in resources for compliance actions to be undertaken by the Australian Taxation Office. The increase in funding is proposed to enable the ATO to deliver a combination of proactive, preventative and corrective activities relating to non-compliance. In particular, it seeks to address the overclaiming of deductions and the incorrect reporting of income. The funding is stated to be used by the ATO to modernise the guidance products, engage earlier with taxpayers and their tax agents, and target its compliance activity. These increased resources for compliance will amplify and enhance the next 5,000 private groups performance program, which is currently in progress. While the government did not have any specific tax announcements for individuals, it did announce a measure that can benefit individuals and businesses while helping to make the environment better by making electric cars more affordable. The measure will make battery, hydrogen fuel cell and plug-in hybrid electric cars exempt from both fringe benefits tax and import tariffs. The exemption will only be available where the car has a first retail cost that is below the luxury car threshold for fuel-efficient cars. This is currently $84,916. As an illustration, where an $80,000 electric car is provided to an employee, the exemption will result in an FBT saving of $15,643 per annum. In order for the exemption to apply, the car must be both first held and first used on or after 1 July 2022. A new car which was purchased prior to 1 July 2022 but only delivered after that date will still be eligible for the exemption. The exemption can provide significant benefits for an individual who is able to agree with their employer to salary sacrifice the provision of an electric car. Not only will there be no FBT liability on that car, but the employee can effectively be placed in the same position as if they received a tax deduction for the costs incurred in relation to the car, irrespective of any business use. Note that despite the FBT exemption, the car benefit will still be a reportable fringe benefit of the employee. In this manner, it will be used for determining certain tax liabilities, such as the Medicare levy surcharge, the private health insurance rebate, and Division 293 tax for superannuation contributions. And it's worth noting that the government will also be removing the input tariffs on these electric cars, which is currently 5%. For individuals, the budget is notable for what was missing rather than what was included. There are a number of items which were discussed or have been providing taxation relief to individuals in recent times, which were omitted from the budget. These items include the low and middle income tax offset not being extended beyond the 2022 income year. This offset had been provided to individuals with taxable incomes up to $126,000 and providing them with an offset of between $675 and $1,500. However, the low income tax offset remains available for individuals with taxable incomes up to $66,667. The maximum offset still remains unchanged at $700 for individuals earning $37,500 or less. So the offset is effectively significantly reduced for individuals from 2023. In addition, the much publicised 50% reduction in the fuel excise has not been extended. Finally, despite all the noise and debate in the lead up to the budget, there were no changes to personal tax rates. Most notably, the government has so far maintained its election promise not to change the stage 3 tax cuts, which are legislated to begin from 1st of July 2024. As a reminder, the stage 3 tax cuts will provide a reduction in tax payable by individuals with annual income over $45,000. It reduces the marginal tax rate for income in the range of $45,000 to $200,000 to 30%, from its current rates of 32.5% rate to 45%. The top marginal tax rate of 45% will be adjusted to start from the current $180,000 to $200,000. This table demonstrates the tax savings that will be available from the changes. As illustrated, the greatest tax savings of $9,075 a year will be made by individuals with taxable income of $200,000 or more. While there were limited changes for tax, there were a few non-tax measures which were announced that will provide benefits for certain individuals. The most notable ones of these include extending the current paid parental leave benefits by 2 weeks per annum until it reaches a total of 26 weeks from 1 July 2026. The provisions will also be extended to enable either parent to claim the leave payments and enable both parents to concurrently claim weeks of the payment. In addition, age and veteran pensioners will be provided with a once-off credit of $4,000 to their work bonus income bank. This will increase the amount that pensioners can earn in the 2022-23 year from $7,800 to $11,800 before their pension is reduced. In addition, there's an increase to the maximum childcare subsidy rate, which is going to increase from 85% to 90% for the first child in care. The childcare subsidy rate for all families earning less than $530,000 in household income will also be increased. Overall, the budget brings very little change for individuals. So I'll pass that now back to you, Amanda. Thanks.
Thanks, Gabrielle. Like you said, not a lot in it, but I'm sure there will be, obviously, when stage 3 hits. But other things, the paid parental leave and the childcare subsidy, that will affect many, I'm sure. Next up, we have Jamie Towers. Jamie's going to be covering our business impacts from the budget. Jamie is a tax partner and manages our Queensland's tax consulting division. For over 25 years, he's been providing taxation advice to a diverse range of clients, from international groups and listed corporations to SME businesses and high net worth individual. He predominantly advises internationally, focused inbound and outbound corporate clients with tax advising, including M&A and restructuring, including tax consolidation and cross-border tax issues. He works closely with our Australian clients to simplify Australian tax obligations and to create effective structures and solutions for businesses and their owners. So over to you now, Jamie, to take us through the budget measures for business.
Great. Thank you, Amanda, and welcome everyone. So I'm here to talk to you today about the business or measures affecting business throughout the budget. And I guess disappointingly, but not unexpectedly, there weren't a lot of tax measures available in the budget, but I will talk through the ones that were announced. And the first one is an integrity measure. And this relates to off-market share buybacks of listed companies. Now, under the tax law, a listed company, or under the tax and corporations law, a listed company has the option of either buying back shares on market, or it can do more of a selective buyback and buy back shares in an off-market transaction. And the tax treatment between the two different options does differ significantly. So for an on-market share buyback, the proceeds that the company pays to a shareholder is treated as consideration for the purchase of shares and therefore treated as a capital gain or loss. Whereas under the off-market share buybacks, the tax laws treat it differently. And the way it's treated is to the extent that the proceeds are not applied against the share capital account in the company, then the balance is treated as a dividend, and the company can pass franking credits onto the relevant shareholder. And the government sees this as potentially, not perhaps an anti-avoidance measure, but it allows the streaming of franking credits to certain shareholders, whereas if it was done on an on-market buyback, then there was no dividend and no franking credits involved. So the government sees that this potentially could benefit some shareholders rather than others, and because of the franking credits, the refundable franking credits could actually reduce the amount of overall tax revenue. So the government is now seeking to align the on-market treatment, the off-market treatment with the on-market treatment. So what will happen going forward, and this applies from budget night, is both the off-market and the on-market share buybacks will be treated as the proceeds of the sale of shares. So therefore, there's no franking credit leakage and no reduction in tax revenues. So while the government had, in the previous government had talked about not touching franking credits, this is a small attempt to reduce the amount of franking credit leakage into the tax system. So next we've got a number of smaller measures. The first one is the fuel tax credit for heavy duties. So the heavy duty road charge is going to increase by, I think it's 1.5% to 27.2 cents. So this will will increase the amount of fuel, and it will affect the amount of fuel tax credits that can be claimed. The next measure that's been announced is in relation to government grants in relation to COVID. So in particular, the Victorian government and the ACT government had announced a number of grants affecting businesses, so helping support businesses through the period of COVID. And unless the government makes them specifically exempt from tax, they would be taxable. So in this announcement, the federal government has made these government grants a non-assessable, non-exempt income, which means that you don't have to pay tax on those particular grants. So it's good news for businesses that have received those grants. The next announcement is not a tax announcement, but it's an energy efficiency grant for small and medium enterprises. And these things have been around for a little while in different guises. So I'm not sure that it's really adding a lot, but it's changing the way that the energy grants are provided. And there's $62 million in a pool to allow SMEs to improve the efficiency of their equipment. And it will allow them to plan the purchase and assist with the purchase of new energy efficient equipment, with the overall view of helping to reduce the carbon in Australia's carbon outputs. Now, the final thing on this page is in relation to announcements by former governments that have not yet been enacted. And unfortunately, and we see this more and more, the governments make announcements during budgets and throughout years, but unfortunately, for whatever reason or another, they don't quite proceed through to legislation. So the Labor government is providing certainty here in saying, well, of these announcements that have occurred in the past but haven't actually been enacted, the Labor is qualifying what will happen in relation to these announcements. And the first one actually goes back to the 2013-14 mid-year economic forecast, which it's quite sad that it's going back 9 years and hasn't been enacted. But the good thing is the government is saying that, well, it's too far back, it's too hard, we're not going to proceed with these rules. And that relates to some debt and equity amendments that were announced back then. And the next one was a 2016-17 budget announcement in relation to taxation of financial arrangements. Again, it's going back 5 years, and the governments of the day haven't been able to agree on how those rules would proceed, so they're not going to proceed with those. Similarly, with some asset-backed financing changes that were announced in 2017 budget, they are not going to be proceeded with. And similarly, again in 2016-17, it seems to be a topical year, there were some collective investment vehicle rules for limited partnerships. Now, they were announced in the 2017 year. Now, it's only in the 2022 year that we've actually seen some rules being introduced for collective investment vehicles. So this is a pooled fund allowing investors to pool their funds to invest into various businesses. While those rules have been passed, there was rules in relation to limited partnerships that didn't get through, and the Labor government have said we're not going to proceed with the rules for limited partnership collective investment vehicles. Now, a couple of years ago, the government, or the former government, had tried to introduce a cap on the amount of purchases using cash of up to $10,000. So any more than $10,000, you couldn't purchase an asset using cash. And this was designed to try to limit anti-money laundering. But it all got too hard. It didn't proceed into legislation, and the government have said we're not going to proceed with this measure. Now, finally, I'll talk about a couple of reporting rules that haven't been enacted, and the government have said they're going to defer the start date of these. And these relate to the sharing economy, so the ride sourcing such as your Uber and your short-term accommodation such as Airbnb. Now, the government is proposing to introduce some new reporting measures so that the government is ensuring that they are capturing that information for tax time. Now, that was proposed in the 2019-2020 year, hasn't been introduced yet, and they are going to defer that until this year for ride sourcing and next year for food deliveries. So it's going to be deferred. So next I'll talk about a couple of international tax measures. And the first one I'm actually quite excited about because during the COVID period, I went for my sins. I went and did a master's degree in international tax, and my thesis on that actually covered this issue, which was thin capitalisation. And my thesis covered how Australia had reacted to the OECD's base erosion and profit shifting laws. And in particular, one of the things I focused on was the thin capitalisation rules. And thin capitalisation is all about limiting the amount of debt that businesses can use to fund their business, because where international businesses are doing that, they can reduce their tax. And one of the measures that was introduced by the OECD was limiting the debt deductions, so your interest deductions, to 30% of a business's profit. And the Australian government at the time chose not to do that. They said our rules work fine and we're not going to align with the OECD or the rest of the world. And I actually criticised that in my thesis. And I'm pleased to announce that the government has finally listened and came up that it is a good idea. So this proposal, which will apply from next year, is to change the thin capitalisation rules. At the moment, we've got a 60-40 debt equity ratio. So if you exceed the amount of debt, then you start to lose tax deductions on the interest. So the government's going to do away with that rule, and they are going to introduce a debt deduction limit of 30% of EBITDA, so earnings before interest, tax, depreciation and amortisation. They're also saying, well, if the worldwide group has a higher level than 30%, we will allow you to cap your Australian interest deductions at the level of the worldwide group's interest deductions. Now, Australia also does have an arm's length debt test. That will remain, but will only apply for external debt. Now, where a business does lose tax deductions because of the 30% of EBITDA limit, they can carry forward those interest deductions forward for 15 years. So if you can't claim it this year, you might be able to claim it in future. So I think this is a really good move, that it's aligning with the OECD recommendations, and it's aligning with a lot of other countries that have already adopted these rules, because this will then allow easier decision making if you're going to be investing into Australia. So just as an example, I've got a profit and loss and balance sheet just to illustrate how these rules will change. Now, in this example, we've got a profit before tax of $1 million, and that's after a financing cost, so interest deductions of $2.5 million. And in this example, there's $50 million of assets, $50 million of liability on the balance sheet, all debt funded at 5%. So under the current rules, you're only allowed to claim interest up to a maximum of 60%, and 60% of the overall sort of debt to equity, whereas the current business is 100% equity funded, so they actually lose some tax deductions. So the maximum deduction they're actually allowed under this scenario is 1.5 million rather than the 2.5. Under the proposed rules, where it's a 30% of EBITDA, the interest deduction is actually reduced further down to $1,050,000. So the result here is that there's going to be additional tax paid by this multinational company of an additional $135,000. So again, it's aligning with OECD. It's benefiting Australia with increased tax revenue by reducing the amount of debt funding of this particular business. Now, next one I'll talk about is another international issue. And in this one, the government is aligning with the OECD's Pillar 2 goal of a global minimum tax rate of 15%. Now, they're taking a slightly different tack and only looking in this instance at payments to international related parties for intangible assets in low or no tax jurisdictions. So in particular, what they're looking at is, so a low or no tax jurisdiction must have a global tax rate or tax rate in their home country of less than 15%, or they have a patent box regime which applies a low tax rate in relation to their intangibles. And as an example, we've got country A has intellectual property. It's charging a license fee to Australia. Australia is buying this product from country B, and the country A tax rate is 12.5%, so less than that 15% tax rate. Now, in this example, we're paying a license fee of $1,000 to the international party, and assuming that was all tax, they'd be paying $125 in tax. But under the current rules, Australia can claim a tax deduction for that whole $1,000, which reduces the profit in Australia. So in this instance, the profit in Australia is reduced to $200, and the tax on that at 30% is $120 in this instance. Now, what's been proposed is that the whole of that $1,000 international license fee will be denied as a tax deduction. So that has the impact of increasing the tax in Australia from $120 to $360. So what we're seeing is big international companies have done this in the past. They've had intellectual property over in Ireland or other low tax jurisdictions, and all of our profits are going overseas in paying these license fees. What Australia is saying is no longer. We're not going to accept that anymore. We're going to deny a tax deduction. While you can pay a license fee overseas, you're not going to get a tax deduction for it. So you are going to pay more tax in Australia. Now, another thing affecting large international businesses and public companies is the Australian government wants more disclosure of tax information. So this is going to affect what we call significant global entities. So it's a company that's part of a group that has more than $1 billion Australian dollars in turnover. Now, these companies already have to provide additional reporting to the Australian government, which shares it with jurisdictions around the world. What the government has proposed is that some of that information, which is currently private, it's only released to governments, the government is saying, well, some of that information should actually be shared more broadly. Now, this was announced over the last couple of years, and there has been a bit of opposition to this, saying it could be anti-competitive. So it will be interesting to see what information is going to be required to be shared out of the country-by-country reports. Now, in addition, Australian public companies are going to have to release information on the tax jurisdiction of their subsidiaries. And any tenderers for Australian government contracts that are worth more than $200,000 will also have to, in their tender documents, disclose where their offshore subsidiaries are. It's trying to ensure that we're not having companies with subsidiaries in low tax jurisdictions getting government contracts and potentially moving money offshore. Of other international measures, we've got a new tax treaty with Iceland, and of benefit to our friends over in Ukraine, any goods imported from Ukraine over the next 12 months, the government has said we're not going to apply import duty and for the next 12 months, just to help them out. So not a lot in the way of announcements for businesses per se, but the government have given a lot more money to the ATO to help with their current programs of anti-avoidance. Now, the first is in relation to the shadow economy, or formerly known as the cash economy. Now, that's been funded, I think, the current program's been funded since 2015-16. It's been extended for a further few years out till 2026. Then the next one is the big one, the Tax Avoidance Task Force. Now, this is aimed at multinational groups and large private groups. So it's been the top 1,000, started from the top 100, now the top 1,000 and into the top 5,000 corporate groups in Australia. So the government has thrown a lot of money at the tax office to investigate these private and large groups. Now, of an additional $1.5 billion of funding, they're expecting to reap $5.6 billion in revenue. So a good spend if it comes through. Now, to assist with that, the government is increasing the penalty unit value from $222 to $275, so a significant jump. So this applies if you haven't lodged your, for example, business activity statement in time. A simple late lodgement penalty will jump from $222 to $275 and increases with the size of business. Or if you make false statements, that's also caught with these penalty units. In addition, the government recently increased the application fees for foreign investors into Australian real estate. Now, they're also going to now double the amount of penalties if the foreign investors seem to be breaching the FIRB rules in relation to Australian real estate. So what didn't happen? There was a lot of speculation as to what may or what may not happen. And given it was a new government trying to work out what the economy was doing, to be honest, we didn't expect a lot and we didn't really get much at all. So no real tax reform. Now, as an active member in the Tax Institute and Institute of Chartered Accountants, I do see a lot of submissions asking for real tax reform over many years, and it hasn't happened. So hopefully over the coming years, we may see something, but nothing occurred in this budget. Now, there was speculation about tax incentives to invest in carbon neutral technologies. Now, that didn't happen. I think partly, aside from the fringe benefits tax on the electric cars, I think partly because through the COVID-19, there was significant incentives to invest in assets generally, and they continue until 2023 and under the temporary full expensing rules. So I think once that finishes in 2023, we might see more initiatives going forward, so in the next budget. We didn't see anything in relation to small business CGT concessions. Now, the thresholds in relation to those have been set in place for, I think, 20 odd years. So well, I would hope that that would increase in due course, but it didn't happen. We've seen no expansion to the GST base or rate. We've seen no budget repair levy for high income earners. That was something that I speculated might occur. I suspect it will occur once those stage 3 tax cuts come in. I suspect that anyone on that top marginal rate may have to pay a high a budget repair levy. That may happen, come in under the next budget or the one after for when those rates come in. There's been, of disappointing news, there's been no clarification in relation to the formally announced tax changes to residency laws for individuals and companies. There's been a few tax cases of late that have clouded the waters in relation to those. The government announced we are going to fix these legislatively. It didn't happen under the last government, even though it's been an announcement for the last few years. I had hoped that the Labor government would say, yes, we agree, we will fix this, but they've been silenced to date. Let's hope that silence means they do intend to do something in the future. And of the last year, there's been a lot of talk about discretionary trusts and the ATO's confusion over how they'll approach distributions. There's been no announcements of a legislative fix for that. So let's hope that will come again into the future. So that's about it for me. A fairly quiet budget overall from a business perspective. So I'll now hand back to Amanda to introduce Michael. So thank you.
Thanks, Jamie. That's great. Thanks for a very informative session. Quite a lot on the international tax side of things this time, less so much more locally. So next up we have Michael Jones, who will take us, this will affect probably more of our local clients in terms of superannuation affairs. So Michael is a partner at Mazars. He specialises in tax, superannuation and estate planning, helping businesses and families deal confidently with their financial matters. So Michael's going to take us through the superannuation matters that was, announcements and key considerations of this year's budget. Over to you. Thanks, Michael.
Thank you, Amanda, and good morning, everybody. So there was no new super announcements in the budget. That's okay. We don't need super announcements all the time. There was some confirmation of existing proposals that the government's supporting and some news around that. And we'll have a look at them and just touch briefly on how they could be of interest to you. For me, though, the most important message for super, because there's always something interesting to talk about with super, is that there's no doubt the government's saying in the next 1 to 2 years, they're going to have to increase tax revenue. And it seems to me that superannuation, and in particular self-managed super funds, are an attractive place for governments to raise revenue. So therefore, I would like to make a suggestion of how perhaps older members of their self-managed super funds and other types of funds are able to perhaps prepare themselves to better manage any future changes that's going to happen in the taxation of superannuation. Okay, so let me start with an announcement in the budget about residency rules for self-managed super funds. Basically, when a member goes overseas, it can cause a real problem for a self-managed super fund and put them at risk of losing their superannuation status. So in the past, there's been a safe harbour that's aimed to help people that are temporarily leaving Australia and give them a couple of years through which they can continue to contribute to super while temporarily overseas. It was a sort of a clumsy safe harbour. It didn't always work well. And there was a proposal from the former government to extend that safe harbour to 5 years, which is very helpful, and also to abolish a active member rule, which causes problems in these circumstances. Now, the new government has confirmed that they support this measure, and what they've also confirmed, though, is that they're going to defer its introduction. So, good news on one hand, but a bit disappointing that it's still going to be some way off before that measure's introduced. Something else I want to note about the budget, it didn't talk much about it didn't talk at all, I should say, about non-arm's length income and expenses. Now, these rules apply significant taxes where a super fund's income or expenses are not valued on an arm's length basis. And parts of these rules are very contentious and produce really unexpected and unplanned outcomes. The former government said, okay, yep, we recognise there's unintended consequences here and we'll create legislation to fix it. So the fact that there was no mention of this in the last budget is a bit of a bother, because that means it's not really seen as I don't know what it means exactly, but I would rather see something strong come out from the government saying they're going to fix it. That's not the case. So if you're at a self-managed super fund and you have related party transactions, pay attention very carefully about how those transactions are valued. Another item in the budget was about the downsizer contributions. And these contributions are interesting. They're special contributions that basically someone makes when they sell their home. It allows an individual to make a one-off post-tax contribution of up to $300,000 per person from the proceeds of selling their home. Okay, it's quite good. It's not new. When you have a couple, both couples can make contributions, and most importantly, the contributions do not count towards the non-concessional contributions cap. Just also, the contributions need to be made within 90 days of the sale actually happening. Now, the change confirmed in the budget was that people can become eligible to make these downsizer contributions from the age of 55. It's currently 60. It'll come down to the age of 55. This is not a new proposal. They're just confirming it. The legislation is well on its way. I expect that this will come in and be effective in the current financial year. But just to repeat, the interesting features of the downsizer rules is that they can, once you've passed that minimum eligible age, currently 60, soon to become 55, you can make these contributions up to any age. There's no upper limit. And they can be made no matter how much the person has already in superannuation. So that makes them very interesting. Timing and sequence of these downsizer contributions is very important. So you should really get advice if you're thinking about doing it. Okay, so let's move on to really this underlying message of the need to increase tax in the next 1 or 2 years, and what people can do to better prepare their self-managed super funds to manage any tax changes. The basic thing I'm looking at here is that it's about tax-free and taxable components of your superannuation fund. So really, most funds were made up of a tax-free balance and a taxable balance. The tax-free component basically relates to after-tax contributions that have been made into the funds. Post-tax savings being contributed into super. And basically, broadly speaking, the taxable components are everything else. So, as the name suggests, the tax-free components of your super fund are better from a tax perspective than the taxable because you basically can access them without paying further tax. What I want to talk about today is a simple thing where it's not new, but it's been made more attractive due to recent changes. So I'm simply talking about recontribution. And that is a simple two-step where you take some money out of your super fund and you recontribute it in. So the same amount of money is in the fund, but these two steps can enable you to convert your taxable component of your fund into tax-free component, and that's useful. I said it's not a new idea, but recent changes have made it much more applicable to a much wider range of people, because previously contributions were only available to people after 67 that satisfied a work test. So now you can make significant after-tax contributions up to the age of 75. There's still limits, not everyone can make these contributions, but certainly far more people can do recontributions and over a longer time frame. I also note something else, that is with the rising consumer price index, the transfer balance cap, which will be measured next on 1 July 2023, it'll increase. It'll either go up to 1.8 million or more. And that's going to also make these recontribution arrangements quite interesting. Finally, I'll note, even at age 75, you can do the bring forward rule, which allows you to bring forward 3 years of contributions. You can do that when you're 75 years old. Quite extraordinary. So what I want to talk about then is that, just to finish up, the benefits of recontribution quickly. Mainly, it's about minimising tax on death benefits so that when you die, if your superannuation is paid to your surviving spouse, for example, there'll be no tax to pay to that. But if it's going to be paid to your adult children, there will be tax to pay on that, but only on the taxable component. The tax-free component remains tax-free. So that's the number one, probably the number one benefit. The second benefit is that when you have a couple, you can use recontribution to equalise your super balance between the couples, and that helps you maximise the amount that can be put into pension, which is a benefit from the tax-free aspect of pension balances. It also means if you equalise between couples in a super fund, when someone dies, the surviving spouse will be able to keep more in super. And the final benefit I'll mention is that if you maximise the tax-free component of your superannuation fund, you're basically going to be better off. As simple as that. We don't know what future changes will be coming in terms of taxation of super, but you will be better off with a higher tax-free component, and it will have long-term consequences. Okay, so I guess my main message for things like this, it's good to talk to your advisor. It's good to have a conversation. All right, so I'll pass it back to you, Amanda, and
Thanks, Michael.
see if I can do that.
We do have one question that's come through the chat, which I think is relevant to you,
Okay.
which someone has asked is, do you really think that the government will increase tax on superannuation?
Well, let me say this. You have, Australia's quite unique. It doesn't have death duties. Most similar economies will have death duties, and they're very, very important to raising revenue. Australia doesn't have that. And of course, it'd be really difficult to introduce death duties, but you can see, I think, in some time in the future, something like it will come. There's other things too. The fact is that self-managed super funds are seen It's a politically effective way to raise money, but also difficult. But I guess here's my answer. It doesn't matter, I think. We shouldn't worry too much about whether they're going to raise tax on super. It's more important to understand what you can do in fairly simple fashion to improve how your self-managed super fund can manage any tax changes and also manage existing tax law. So that's really my message. Don't worry too much. Will it happen? Will it not happen? It's just better to get your house in order and be as best prepared for whatever happens.
Yeah, I tend to agree. And like you mentioned, there's not a lot of new measures, but some of those ones that have been previously around and introduced, particularly the age limit reductions, I think that will certainly help a lot of our client base get some funds into super.
Indeed.
Still a very attractive tax environment, isn't it?
Absolutely.
Yeah. Thank you. All right. Well, I do have a question here. I think, Jamie, for you, I'd throw it to you, which is we note that you talked about the additional funding of the ATO in relation to the change in penalties. Bit nasty. It was quite a significant increase. But what are your thoughts on, audit activity? Do you think that, the ATO are going to become more aggressive in their audits and collections?
Well, as I mentioned, those programs around the shadow economy and the investigations on the sort of top 1,000, top 5,000 taxpayers, they've been proceeding for a number of years already, and the ATO is working their way through those lists of taxpayers. And for the really large companies, there are ongoing. So they've got ATO officers sitting in the premises of these large companies, making sure they are complying with the law and providing a justified trust to the community and say, yes, we are paying the right amount of tax. So that will be ongoing. I do think that the ATO's programs will keep filtering down and investigate more and more people. What we are seeing is that the ATO have changed their approach to their debt collection. So all throughout COVID, the brakes are on. Just leave businesses alone. They need all the cash they can to help pay their staff, etc., keep the businesses going. And we've seen a significant change in that behaviour. And they are now being a lot more aggressive in contacting taxpayers, asking where their money is. We've seen a big issue in director penalty notices, so asking the directors to pay the tax liabilities of the companies. So we've certainly seen a shift. And it will be interesting to see over the next little while, with the inflation going up, businesses are still struggling as to how that occurs. So I think the audit activity will certainly continue and increase, but whether the ATO tempers their behaviour on the collection will be interesting to see.
Yeah, and I think we've always talked to our clients around the lodgement is probably the most important piece. The payment. Absolutely. They want it, but it's really around the lodgement, isn't it?
Yeah. An interesting thing that happened during the last year as well is that where businesses or where taxpayers have a debt of more than 100,000, the credit agencies are being notified. So it will affect your credit rating. So it's really important to get on top of these things.
That is very important. Absolutely. Gabrielle, I think I'm going to throw this question to you. Aside from, the FBT on the electric cars, I did want to ask, actually in relation to a car, if it was purchased before 1 July 2022, can the client still receive the FBT exemption?
Well, strangely enough, yes, they can, but it all depends on timing. So what the provision relates to is that it must be first held or first used on or after 1st of July 2022. So if you've purchased the vehicle and it's legally yours before that date, and you haven't received delivery of it, then yes, you are still entitled to the FBT exemption. However, if you got it delivered and first used it on the 30th of June, then you're not eligible. So it all depends on the timing. And given the delays in getting it cars at the moment, there's probably a few people that are actually going to get the benefit of that FBT exemption, even though they've already purchased the vehicles for their business.
That's interesting. You're right. There is still quite a lot of a delay on those new vehicles coming through, isn't there?
Uh-huh.
I think that might be it. Does anybody, if anyone has any other questions, please throw them into the chat. Ask a question now. I do have one final one we might sort of creep in. Is this probably addressed more so to you, Gabrielle, is what's the sentiment in relation to the proposed individual tax rate changes from moving forward? Given the new government's focus on debt and rising cost, is it still likely, in your opinion, that these new tax rates will come into effect from 1 July 2024?
It's a bit difficult to tell. So it's certainly legislation. It is in place and it's all ready to go with effect from 1st of July 2024. However, as I think everybody's noticed the last few weeks, it was definitely put in the air to find out what is the sentiment in relation to removing these tax cuts. It clearly came down in favour of not doing it this year, but there's got at least one more budget to get out before those tax cuts come through. So there's still a big chance that they might reverse that decision. I don't think it's a good decision to reverse it, given that a lot of this is bracket creep. When you think that $180,000 has been the top marginal threshold for quite a few years now.
Yeah, definitely.
Salaries have exploded, and so a lot more people are on a higher tax rates than they should be as a result of bracket creep. So personally, I think they should remain. The government has certainly given indications that it's trying to reverse it. They did go to the election on the promise that they would not change them, and the Liberals are going to try to keep them to keeping those changes. So fingers crossed that they do stay.
Yeah, I tend to agree with you. I think, with the resourcing, issues that I think, a lot of people are experiencing in Australia, is that I do think those wages are going to need to creep up and the tax bracket needs to follow suit.
Exactly. Mm-hmm.
All right, I think that's it. There's a couple of questions around whether or not we can people receive a copy of the slides for their reference. Absolutely. So along with a recording of the presentation, we will also be issuing a copy of the slides for each person that attended the webinar. So thank you very much to our presenters today, and then thank you for our audience for attending. We hope that you've at least been able to take a couple of things from today and enjoy the rest of your day.